Thank you, everyone, for joining our first investor training session, part one. My name is Ryan Correa. I'm one of the managing directors of Equivesto. With me, I have my co-founder, Alexander Morsink,
Good
who
evening.
is our subject matter expert and also, like I mentioned, my co-founder. Here are a few things that we're going to be going through. The first thing that we're going to be covering is what is angel investing? Really, the basics around what is the definition of angel investing, and what are ways that you can start to get involved, private versus public investing, why do people invest in private companies, who is angel investing for, the Canadian investment landscape as a whole, how to get started, and of course, equity crowdfunding investing. In future parts, we're also going to be covering assessing opportunities, so valuation, due diligence, as well as building your own investment strategy. And further down the line, we'll also start to talk about eventually how to actually manage your angel portfolio. Okay, so starting at the beginning, what is angel investing? Angel investing, in the most traditional sense, is a type of private equity investing in which high net worth individuals, so people who are wealthy, who have a lot of money, provide their capital, their money to early stage startups, businesses in exchange for some level of ownership. So that could be in the form of equity, that could be in the form of debt, that could be any form of security. Essentially, it's a barter between cash for some level of ownership into a business. These types of investments are typically made into startups with what we call high growth potential. And I'll define that in a later slide. It can come with other parts like mentorship, network introductions, and any other resources, but these are not really a requirement. At the bare minimum, all that you need is simply the cash for ownership. And the main goal of angel investing is to obtain really outsized returns than what you could typically find in other investments, say in the public markets, GICs, mutual funds, ETFs. It's really about investing in private things that could have higher potential return, but of course that comes with an equivalent higher risk of loss. So you have to kind of weigh those two things out. A simple example that I put together at the very, very bare minimum was, say you invest $10,000 into a startup, company A, for about 10% ownership into that business. You wait 5 years and that company eventually sells for $5 million. Assuming there was no dilution during that period, meaning other investors participating during that 5-year period, and there are no liabilities or other expenses that were incurred due to that sale, you're going to get about $500,000, so a return of investment of 50 times. So how do angels invest? So here are a few points that we'd like to cover. Like I mentioned before, that term high potential company. Angels like to invest at the early stages of a company, like the MVP stage or to the sort of startup stage, because given the check sizes that they're willing to put in, it gives them a sizable enough amount into a business that they can have somewhat of an ownership and no fear of too much dilution in the future, as well as being able to know that a company is at a stage that it actually has what we call a minimum viable product. Anything earlier, sort of the ideation stage, it's just a little bit too early for most businesses, for most angel investors, and it can go many ways. Many people don't actually ever get to the MVP point. So MVP is usually the minimum that we see in terms of high potential companies. Now, other things that a high potential company would typically be is usually in the technology sector or have some sort of technology in their solution. So a lot of times angels are looking for companies with something with like a very explosive amount of potential if their technology is disrupting an industry or some level of innovation in a sector. And they're mostly looking for larger exits. So the typical term we see in the industry is greater than 20 times or 20 times return on investment. So if I were to put $10,000 into a company, I'm expecting at least $200,000 in return. So they're using that in the back of their minds whenever they're making assessments. And we're of course generalizing. There are many ways that an angel investor can invest, but in the most standard practice, 20 times is what we see.
And
They're also
don't worry, we'll talk about what an exit means later on as well.
exactly. What is a diverse portfolio? So another area that an angel is looking to participate in is have a wide range of companies they invest in. There's a typical and a very standard term that we see: don't put too many eggs in one basket. So investing in a wide range of companies, sometimes we see about 10 to 15 per angel. Sometimes it could be more, sometimes it could be less. This allows you to spread your opportunity and your risk. Time horizons that we see typical and angels participate in can be anywhere from 5 to 7 years, sometimes more, sometimes less. It's really dependent on sector, industry, I guess the stage of a business. There are a lot of factors involved in terms of time horizon. The typical check size that we see angels write can be anywhere from $10,000 to $100,000. Like I mentioned before, this really depends on the stage of a business, the industry that they're in, and what are the norms. The sweet spot that we've seen in our experience is around $25,000. Another way that angels like to participate are in groups. So angel syndicates, investment clubs with their colleagues and friends. There's a social aspect that is associated with angel investing, and we have a slide later on that we could talk about that. And another major factor is angels look for quality over quantity. Most typically, angels invest in about 2% of the opportunities that they receive, maybe less. This is due to the excess amount of startups that are actually looking for capital, and just how few people there are available with that type of cash. And also, they're being selective with their investments. Investments in startups are risky, and to hedge that risk, making sure that they do proper due diligence and review of a business before they make an investment is important, and many businesses don't make it through that. So that's why quality over quantity. So angel groups. I have a few examples here of what angel groups are, especially here in Ontario. So you may have heard of a few of these: York Angels, Maple Leaf Angels, G10, Equation Angels. Angel groups are essentially a community or network of high net worth individuals who collectively invest in startups, either individually or as a syndicate. Syndication is the grouping of capital through an investment vehicle. So it could be a limited partnership or a special purpose vehicle to invest in a deal. Essentially, they are spreading the opportunity and the risk to more people, and also allowing for more centralized decision making. So making it slightly more efficient by having maybe a few people in charge instead of many people in charge. Another trend that we've been seeing in the market is this increase to move online with platforms such as AngelList or even Equivesto becoming sort of the modern angel group. So this is something to look out for in the future. So some of the myths and truths that we've been seeing, and I guess a lot of people learn about angel investing through online shows and things like that. Some of the myths that we've been seeing: angel investing is about being sort of ultra wealthy and having entrepreneurs sort of beg for your money. This simply isn't true. It's actually a lot of work to be an angel investor, and it's actually active effort from angel investors to go and find good deals. Angel investing would automatically make you rich. So you throw a few dollars into multiple businesses, and all of a sudden you go from being a millionaire to a billionaire. That's completely not true. In many cases, a lot of startups fail, and it takes a lot of work and time to actually hone the skills in order to be successful at angel investing. And I put a third point there. Much of this has been sort of glamorized by popular TV shows such as Dragon's Den and Shark Tank. That's not reality. A lot of angel investing is actually done in much more humble ways. Some of the truths that I pointed out: angel investors are just regular people too. They have strengths and they have weaknesses. So that's something to keep in mind. Successful angel investing takes, a lot of time, effort, and skill. And really great angels are always actively looking for quality opportunities to invest and are constantly expanding their knowledge. So, attending training sessions like this, joining a community where you can learn from others is extremely important. And great angels and people who are successful in the space are willing to learn from others.
Thank you, Ryan. That was a very informative introduction to angel investing. Continuing on what you were talking about, let's sort of dive back to some of the core basics of what really is angel investing and what does it mean to invest in a private company instead of a public one. So for most of us, whenever we think about investing, and any experience we've had making investments before have actually all been in the public markets. What do I mean by public markets? I mean investing into companies or investment opportunities that are listed on a regulated stock exchange, like the Toronto Stock Exchange, the New York Stock Exchange, or the NASDAQ. And essentially, there are some core differences between investing into a public company or a public investment offering, like a mutual fund, like stocks that you could buy on those stock exchanges, through direct investing with TD or any of the other larger banks, or through mutual funds that you would get from your financial advisor. Private investing is giving you the opportunity to invest directly into private businesses, companies that are not listed on a stock market. But I want to highlight some of those kind of core differences. The first one, and probably the most important, is the liquidity. What do we mean by liquidity? Liquidity is the ability for you to take your investment and sell it in a very short amount of time if you need to get money out of it. So if you've bought a stock like Tesla, any day during the week, not the weekend, but any day during the week, you could go through your sort of self-directed trading app and sell the stock that you had bought. And in a few minutes, the stock will be sold and you would have money deposited into your trading account. That's because stocks are traded on a stock market, which is a location created to allow the easy exchange of shares between different investors. With private companies, they are not listed on stock markets. That's why they're private and not public. And so you as an investor don't have the same opportunity to, anytime you want, go and sell that stock to another person, unless that company has specific clauses or rules in the investment agreement that allows you to go back and sell it back to the company. You would generally be restricted from being able to go and sell that to another investor. So when you're thinking about one of the core differences, okay, what's the difference between public and private investing? The main one is, if I'm investing in a private opportunity, a private company, a private fund, something like that, I probably won't be able to get my money back out for a long period of time. That's very important to keep in mind. The next major difference would be the amount of information available. In order for companies to list on a stock market and be able to allow that sort of trading that I just mentioned, it's important for all investors to have access to the same amount of information. So all public companies are required to provide ongoing reporting of material updates to the business in real time, as well as provide audited financial statements that they publish to everyone every year, as well as quarterly financial statements. That's every 3 months. So for public companies, there's a lot of information that's available, and there's a lot of other people, professionals, doing research on this information, coming up with recommended share prices and what they think, and lots of discussion about the value of these companies. That is not happening in the private space. Private companies have no responsibility to provide information to the general public at all. And as an investor, or once you are an investor in a private company, the most information, or the only information that would be legally required, would be for that private investment to provide you an annual financial statement. But that doesn't even need to be audited by accountants or auditors or anything like that. So the level of information that you have as an investor is really kind of controlled by the company itself. Next major difference is going to be the return potential. And this is really what draws people to investing in private businesses. Everything that we've sort of talked about so far, the differences between public and private are all negatives. Why would I invest in a private company if I can't get my money out the same way I could in a public company? The main difference is the potential return. And Ryan talked about this as well earlier in the presentation. Really, when people are participating in angel investing, what they're looking for is a company that is new and going to be growing quite rapidly over the next few years and become a very large company. Think about things like Uber, Facebook. They've got that technology that's going to help them scale quickly without needing to hire, hundreds of additional employees. If you think about Walmart, for Walmart to go from one single location to all around the world took 50 years because they needed to be able to physically get more stores and fill them with employees and figure out how to ship all that produce and the items that they're selling to all those locations. Uber is just an app. As long as there are people who are willing to get in cars and drive around, and there's people who are willing to get on their phones on the app and hire drivers, Uber can operate anywhere around the planet. So that scalability means the company can very rapidly go from something small to something large, making a lot of money. And so with angel investing, investors are looking for these kind of companies that are at that early stage. They need that money to help them scale quickly. And angels are hoping to get in sort of, if not on the ground floor, on the first floor, on the way all the way up, to the top floor of the building. However, this entire model, as Ryan also mentioned, is quite risky. All of these different factors that we've already mentioned combined together creates an environment where the private company is a relatively new business. Potentially it's untested or it's not tested at scale. And so you are taking a chance as an investor to see if this business is going to be able to scale and grow in the way that it hopes, and in the way that you hope, and the way that the founders hope. When you're investing in a public company, the business is already large and operating. They've got millions of dollars that they're dealing with all the time. And you can see that the business is, most likely going to continue functioning. Even if the stock market declines or something else happens, the company itself is most likely still going to keep operating for at least the sort of medium term. So it's not like you're going to invest in a public company that the next day is suddenly going to go bankrupt. With private companies, there is a lot more risk associated with the survivability of the business, but that comes with and compares with some of the potential. Really, the core differences is that risk piece, and that counterweighs the potential of that company. So you should really make sure, as somebody considering doing angel investing and investing in private companies, that you feel comfortable with the amount of information that the company is providing. And if you have access to additional information or reports provided by, for example, Equivesto or any sort of additional platform, you take advantage of those. And then also, when choosing your investment, you do think about the higher risk associated with that investment, and you should only invest if you feel comfortable risking the entire amount that you invested. But why do people invest in private companies in the first place? There are really 6 main reasons. We talked about the first one a little bit, and we'll go into that in a bit more detail soon. But the first one is the potential financial return. It's the potential that the company is only getting a small amount of money from you at the beginning, but that's really going to scale rapidly over time. But how do you actually get your money out of a startup? We've talked about it being a private company, so you're not able to, immediately go and sell your investment. How do you get your money out of a private investment? There are 3 ways that you can actually earn returns from an investment in any company, whether it's public or private. And the first one is going to be through some sort of exit. So that is going to be, the startup is. And by exit, we just mean taking your money out. So how do you actually get your money back as an angel investor? So if the private company gets acquired, so let's say it's a company making an innovative technology in the telephone space, and so Apple wants to buy it, Apple would come in and buy the entire company. So what that means is Apple would buy every single share that's existing that the company has created, including those held by the founder and those held by you, another investor. That's really what's going to help you get your money out. The second would be potentially an IPO. So this would be a company going public and actually transitioning from a private company to a public company listed on a stock exchange. This is finally going to give you the opportunity as an investor to sell your investment to another investor. So that creates another opportunity for an exit. And the third is a dividend. And a dividend is essentially when a company takes some of the profits that it's made in that year, and then instead of keeping those profits in the company, it pays those profits out to the investors who've invested in the business. So when angels are looking at startups and companies that they're wanting to invest in, one of the things that they'll be thinking about, and we'll talk about this in other sessions that we'll hold on angel investing, is understanding from the founder what the founder is working towards. Because one founder might be working towards an acquisition, a different founder might be working towards an IPO, a third might be working towards dividends. These sort of different exit opportunities for an investor will help you as an investor think about maybe how long that's going to take. Acquisition can potentially happen sooner than an IPO. A company needs to reach a certain size or volume to actually be able to go public and list on an exchange. It's quite expensive to go through the process, whereas acquisition could potentially happen at any time. The work the company might do to prepare for an IPO versus prepare for an acquisition would also be quite different. So when you're thinking about the investments that you might be making, you want to think about your own time horizon and when you're hoping to get your money out and which exit sort of aligns with that. What do we mean by time horizon? Well, since companies, you don't have the ability to sell your investment whenever you like when you're making a private investment, time horizon is really representing the amount of time that you're willing to leave your investment in that company and have that investment there. So if you're investing for a specific purpose, let's say you're in your late 40s and you're making investments and you're thinking about retiring in your early 60s, you might be hoping to have, your money out of your investments in the next sort of 10 to 12 years. So when you're making decisions and thinking about where you want to be investing, you want to think about how long it's going to take the company to go from the stage that it's at to a stage where you might be able to get some of your money out and through some sort of exit that we've highlighted here. So it's important to sort of think about those for yourself before you really start getting into making more investments. Let's talk a little bit more about the financial return itself. So investing in startups is quite risky. And part of the reason, one of the core reasons, is the businesses themselves are very new. And so the business is essentially trying to bring an entirely new company, a new product to market. So not only are they going to have to make sure that they actually have a good product and the product makes sense, but they'll have to make sure that there is demand for their product. And then when they've confirmed that there's actually people who wants to buy their product or whatever it is that they're selling, that they can scale that enough to cover the costs of operating the business. So all these different core fundamental questions are going to need to be tested by the business as part of their sort of finding their footing and getting launched as a company. And that's really, what we're talking about when we're talking about investing in startups or early stage companies. They're really at the beginning of their sort of company journey. They're figuring out exactly what their product is, who their customer is, and whether those people want to buy their product and whether selling it to them at that price is going to help them make money. As companies start to figure that out, then they move into a later stage that we call growth stage. And a growth stage is basically when a company's already figured out, okay, these are our clients, this is what we're selling, all these pieces all make sense. And at that point, they're really just trying to grow the amount that they're selling, grow the amount that they're able to make money from their customers. Angel investors are typically participating at the earlier stages. And so when you're thinking about companies that you're investing in, the failure rate is going to be quite high. 20% of startups fail in their first year and 60% fail in their first 3 years. Of the remaining 20%, so that's 80% fail within the first 4 years, because it's 20% in the first and then a further 60 in the first 3. So 80% of these startups are failing, really. Of the remaining 20% that succeed, some of them will have mild success. So they'll be generating some returns, they'll be a viable business, but they're not going to sort of hit it out of the park and become worth billions of dollars. When a company is valued at over $1 billion in the startup ecosystem, it's called a unicorn. So not all of them are going to become unicorns. Only about 5% will have really kind of sizable returns. And when we're talking about outsized returns, we really mean returns at a higher sort of percent return per year than you would ever expect from any other investment. So when you're thinking about, your mutual funds or an investment in the S&P 500 ETF, you're looking at, 10, 15, maybe 8% per year, or you're in a GIC and you're making 2% per year. With outsized returns, we're talking about thousands of percent return, certainly hundreds of percent return on an investment over a 5 to 7 year time horizon. So really kind of ridiculously huge potential returns, but the likelihood that you find a company that does that is going to be quite low. So how do investors actually end up getting this sort of 20 times return that they're looking for, 20 times resulting in 2,000% return? They're picking multiple deals to invest into. So even though angel investments are typically made at a $25,000 check size, individuals who are participating traditionally have a serious enough net worth that they're willing to deploy 10 or 15 $25,000 checks into these companies, into a variety of different companies. Investors will often look to focus on sectors or industries that they understand. If you're an engineer and you worked in sort of solar energy for your entire career, you're going to have a really strong base of knowledge in that industry, and you would be very well equipped to review and assess the strength of a startup in that industry, a lot better than I would be, because I don't have a background in solar energy. So picking an industry that you understand helps you understand and choose a company potentially better. Another important thing for investors to do is to complete due diligence. We recently gave a presentation on understanding exactly what due diligence is, and we'll have more information on that in later presentations. But due diligence and basically understanding all the details you can about the company before you invest in it is very important. One of the most key pieces that new angels sometimes overlook, but are really important to keep in mind, is actually the idea of investing in a founder as opposed to investing into the company itself. As the company is kind of growing and trying to find its footing, like we described, the company may need to pivot, which means sort of changing their focus, changing their product, changing their customer, their target customer, changing all of these things, and really finding a founder that you believe in, you agree with their character, you agree with their experience and the work that they're going to put in, who you trust. That is often what's going to make the difference, more so than picking a company that you think is targeting a really great problem. So paying attention to who the founders are, and if you believe these individuals are worth taking a chance on, is going to help direct you much better in making your choices. And as I mentioned previously, make sure to look closely at the exit strategy that the startup is presenting. Every startup is going to have their own timeline, their own goals, their own targets. And even though when we look at these goals, we know that they're basically 99% not going to be achieved because no one can predict the future, understanding what they're working towards will help you make sure that that aligns with your own personal goals so that you can have the time horizon that you're looking for. Angel investing is for people who have some additional capital that they're willing to take an additional risk with in order to try to get some of these higher returns, but they're really willing to risk their entire investment. They're not putting their entire investment portfolio into high risk companies, certainly not, and we would very much not recommend that. They have enough net worth that they're able to take a small piece of that and say, okay, this portion I'm willing to put towards higher risk businesses. It's for individuals who have the aptitude and willingness to take time to assess businesses, the founders, and the environment that that company's playing in. If you're not interested in spending a lot of time learning about new innovative companies, angel investing is probably not for you. It's for people who have time in their life to learn, to take meetings with companies who are trying to pitch them, who have time to review investment materials and sort of spend on choosing these investments. And then finally, it's for people with an appetite and a willingness to invest into things that are uncertain with potential, but you won't know for a long time. So you have to be willing to make that investment and not know if it's going to, pay you out in the way you're hoping for a number of years. Of course, hopefully the company's going to be sending you email updates, every couple of months or every year, letting you know how things are going. Feel free to reach out and check in with the company. You want to kind of keep tabs on how they're doing, certainly so you could even offer to assist in some way if the company's needing help. But you're not going to be able to get your money out for quite a long time. So keeping that in mind is important. Angel investing is not for people who need returns immediately. If you're investing and you want to be able to invest in the short term and get some returns right away and get your money out, angel investing is definitely not for you. It's not for individuals who don't have some existing investments in other areas. Because angel investing and investing in startups is considered really high risk, it's important for an investor to have and spread their investments across multiple different areas so that they're not only exposed to one very high risk type of investing. There's lots of great lower and medium risk investments that you should also be considering. And it's great to include angel investing and investing in startups as one of the options and one of the areas you're putting your funds. But we would highly recommend that people not invest exclusively into private companies or startups through angel investing. And angel investing is certainly not for people who are going to easily get anxious or experience anxiety from not knowing how the investment is doing. As we talked about earlier, investing in the public markets, you can check the price of the stock every day. That's changing all the time, but you can always go and look at it. With a private investment, there's no real-time ticker showing the value of the company. The value of the company is only going to change if somebody else comes in to invest in the future, or if the company undergoes an appraisal. So if you make an investment in a company and they're not planning to raise capital for 2 years, you will know, okay, maybe their revenue's gone up. Okay, they hired some new employees. They expanded their office. Those will be some indicators you get. But you're not going to get an email saying, hey, you invested at $1 a share and now we're at $4 a share. That's not going to happen until the company goes out to raise capital again, or as I mentioned, there's an appraisal. So you won't really know, you won't be able to track on a day-to-day basis how the investment is doing. Let's talk about the investment landscape and who some of the players are in investing in private companies, certainly in Canada, but also in the United States, and where do angel investors really kind of fit in that? So on the y-axis, we have the investment amount, and this is not directly to scale. So at the bottom, we have 100,000, and then we've got 1 million, 5 million, 10 million, all the way up to 100 million. And on the x-axis, we have stages. So just to provide a bit of context, ideation would be the stage when the company is truly just an idea. It's being created by the founders, but they haven't done anything for it yet. MVP, as Ryan defined, would be minimum viable product. Minimum viable product is really the base product or service that you as a company are actually going to bring to market. If you're selling a shaver or a watch, it's going to be the first physical watch that you've created, or a demo version of that watch that you can show to people physically and they can touch it. If you're building an app, it's going to be the first maybe beta version of your app, something like that, something physical that investors can see and kind of look at and experience. After the MVP, then you're going to be in the sort of startup stage. So this is that stage where companies are really finding their footing. They've created a product and now they're really testing that product in the market. They're taking it to potential customers, seeing if people are willing to pay for it, and seeing if the price that they're charging is enough for them to cover their costs. Once that's all kind of figured out, then they move into the growth stage. This is when, as I mentioned, they're rapidly growing, trying to gather more customers, bring on more employees, and really scale the business. And then expansion is really the final stage. This is when the company is very established and is potentially going to be considering something like going public through an IPO, or is certainly, worth hundreds of millions of dollars at this point. And, as we said, not every company makes it through this whole thing. Probably, 80% of the companies won't make it past the startup stage, but it's important to know kind of all those stages. And they correspond to different community partners, different investors, different groups in what we'll call the startup funding landscape, who are all working together to try to help these companies grow. So when companies are just getting started, and it's really the idea held by the founder and maybe a few people, the only place that a company at that size is really going to be able to get funds, investment funds, is going to be from friends, family, immediate people that they know. Sometimes it's jokingly referred to as the 3 Fs: friends, family, and fools, because you're willing to put in that money at such an early stage. But also there'll be other what we call non-dilutive sources of capital. These are types of funds that can go into companies without the founders needing to give up any ownership. So this would be grants, money from the government, the company going and winning pitch contests that have a cash prize, or potentially incubators offering loans or other support. So those are really the sources of capital available to startups at the beginning. The reason why these are the only groups available at this time is because investors who don't know the founders personally typically will wait until the company has at least developed some sort of physical product or representation of what they're trying to build before considering making an investment. And this is to make sure that the founders can at least create the baseline of what they're saying. If a founder is saying, oh, I'm going to make the next Tesla, and a bunch of people give them money before they've even gone out and made a car, if they can't even, put a car together, then all that money would have been wasted up into that point. Once the company has created that minimum viable product, though, that's when they really start to unlock a lot more funding options. So angel investing is really the sort of traditional investment group and individuals that were funding companies at this stage. Equity crowdfunding, which is what Equivesto does, is relatively new in Canada and covers this space as well. So that's why the green and the orange box kind of overlap at this early stage. But really, once the company has created that minimum viable product, angel investors, equity crowdfunding platforms, and family offices are all different groups that are willing to start investing in companies at this early stage. Just for definition, a family office is essentially a group of people, a small company that's been hired to manage the money of an ultra wealthy person. So wealthy people can become angel investors, and once they become so wealthy beyond what's called super angels, once you're getting into the hundreds of millions of dollars of personal net worth, it starts becoming more effective for you, instead of going to a bank and speaking with a financial advisor, to literally just hire an office full of people to manage your money. And so those are called family offices and manage the wealth of multi-millionaires and billionaires. So family offices, angel investors, and equity crowdfunding platforms all participate at this MVP stage. The reason why this works so well for angel investors and for equity crowdfunding is, at this stage, because the company is still so new, the value of the company is going to be much lower potentially than it will be in the future. And so comparing the value of the company to that $25,000 check that you're writing, you will be getting a slightly larger piece of the pie by investing earlier. If you were investing $25,000 into Facebook right now, which is worth billions upon billions of dollars, you're getting 0.000000001% of the whole company. But if you were investing into Facebook when it was just getting started and worth $3 million, your $25,000 or $50,000 check would get you at least 2, 3, 4% of the company, and that will sort of help you really grow that value and make some really strong returns if the company survives over time. So that's typically why angel investors and equity crowdfunding investors participate at the earlier stage. Once the company makes it through that kind of startup stage and they're looking to raise larger amounts of money, $1 million and up, that's when they start to access even more additional capital. So they can still raise from angel investors, family offices, and equity crowdfunding, but now they can also add into the mix things like venture capital. So venture capital represents actually venture capital funds. And essentially what that is it's a private investment fund that invests into startup businesses. So instead of investors investing directly themselves as angels, they can pool their money into these funds, and then professionals who run the venture capital fund will go out and pick companies that they think are great and help manage those companies and grow them. So venture capital firms really start to participate once companies are looking to raise, more than $1 million, and the companies have started to have traction. They have revenue, they have sales. That gives the venture capital firm at least some sort of revenue to say, look, this company is creating something, we can help them grow that. And then as companies expand and start owning more and becoming much larger, that's when they can get into, loans and things from banks and access more traditional types of funding that you or I might recognize. And of course, as they get much, much larger, that's when they start going after private equity. Private equity, which sounds very similar to what we're talking about here, investing in private companies. Essentially, private equity is referring to the most senior level of investing in private companies right before those companies might go public or IPO. So private equity firms invest at the later stages of the startup cycle into companies that are worth, hundreds of millions of dollars already. And then, of course, companies could actually go IPO and list on the stock market. What do you do next if you're saying, okay, I want to try out angel investing? So the first thing you want to do is make sure that this is the right thing for you. So you want to think about some of the things that we talked about in terms of, the time horizon, the risk associated with investing, as well as the potential return and the amount you might needing to be investing into companies. And then you might want to consider joining an investor community. Equivesto has an investor community, and there's angel syndicates and other groups like Ryan mentioned. This will help you meet other like-minded investors and potentially do number 5, which is learn from your peers, learn from other investors. You also then want to start listening to startup pitches. There's companies, and we'll talk about equity crowdfunding in a little bit, but there's companies currently raising capital on the Equivesto platform. There's also a number of other organizations in the startup community, like accelerators and universities, that will have pitch days or demo days where you as an investor can come and listen to startups pitching their business to you. Next, you want to practice assessing companies. You want to actually start listening to those pitches, gathering information, and seeing how you feel about it. Does this feel good in my gut? Does it not? Okay, if I talk to this very experienced angel, does it feel good in their gut too? Is there something that I might have missed? Let's have a conversation together, which is step 5, learning from your peers. Number 6, access more training. Training is typically a bit hard to find for angel investors, but hopefully things like this and other angel groups are doing a lot to change that and make that more accessible to everyone. And finally, number 7, get your feet wet and make your first investment and see how that goes. Equity crowdfunding is really about allowing a larger group of smaller investors, not necessarily shorter investors, but investors investing smaller amounts of money, to participate in investing in companies in smaller amounts. That allows it to sort of gather into one larger investment. Really, the focus is about removing that $25,000 check size, which removes the need for angel investors to be super high net worth and removes a lot of the challenges associated with the risk of putting such a large amount of money into one company. Equity crowdfunding essentially allows the general public, Canadians, to have access to private companies, startups that are looking to raise capital, and gives you the opportunity to invest in them in smaller amounts. So you can test out investing in private companies, see how it feels without needing to risk thousands of dollars. You can invest in much smaller amounts. The platform also helps because to list on a platform like Equivesto, companies need to undergo a due diligence process, something we call know your product. Essentially, they need to be reviewed by the platform to make sure that, you know, the things that they're saying are true, and any statements that they're making are sort of being verified, that their team has all undergone background checks, and they're providing the right information and documents to investors so that investors can fully review the strength of the company. So using that due diligence so that, you know, when you look at a deal on a platform, you can say, okay, I feel comfortable because I know, you know, this is a real company, all this does exist, it's not a fraud, all this stuff is true. That then gives you the space to do what I call the fun part of due diligence, which is assessing, you know, do I agree with the value of this company? Do I like the terms that the company is setting for me? Am I happy making an investment in this company? Do I think that the founding team is great and they're taking the right approach to this market? All that sort of assessment, I consider the fun part of the due diligence. And that is, of course, still left up to the investor, but the more boring background check stuff is already taken care of. Another benefit is additional access to deal flow. So one thing that you want to do when investing in private businesses is make sure to invest in a few different ones so that, you know, if one of them doesn't do well, because, you know, many of them statistically will not succeed, you have a few other options that you still really like and are excited by your investment in them. An equity crowdfunding platform has a lot more deal flow and brings it, making it accessible in one location for you to review and assess quickly, which is a bit easier than having to go to a number of different pitch events and listen to the pitches and always be available on the specific evening of that pitch event. An additional benefit of using a platform is the terms of the deal are already set. Platforms like Equivesto take the time in advance to set terms with the company. So there's a valuation that's preset, the type of shares in the company that you're buying are preset. All these pieces are already organized, so you don't need to go through the negotiations. If you have questions about things, if you don't agree with the valuation and things like that, definitely reach out, talk to the platform, talk to the company, and potentially you can get some more information that might help make things make sense. But certainly, at least when you arrive, you know that those things are already taken care of. Because everything is all done digitally, it's possible for you to really look at and monitor your investments in one location. You can sign the documents much easier. You can move the funds without actually having to go to the bank. All of that process is made easier for you. Membership is entirely free. So angel syndicates, angel networks that we talked about earlier, they charge annual membership fees, and attending their events usually cost a fee as well. With an equity crowdfunding platform, it's typically free for all investors. A platform like Equivesto also facilitates larger traditional accredited investor rounds. So while you can come to the platform and write smaller checks like you know, $100 or $500 or $1,000 into an equity crowdfunding round, Equivesto is also still facilitating more traditional angel rounds where you're writing $10,000, $20,000 checks for companies, but adds in a lot of these benefits that we already talked about, like the documents being available, some of the initial due diligence being done, and it all being in one location. And so that really gives you the ability to gradually increase the amount that you're choosing to invest in different companies as you become more comfortable in the space and gain more experience. You can definitely visit our website to learn more in the Learning Center, equivesto.com/learn. You can also join the Equivesto investor community, community.equivesto, where other investors are already signed up and people are open to talking about, you know, different deals that are raising on the platform. Well, thank you very much, everyone, for joining. It's been a pleasure speaking with you this evening.